All right, let's talk about something that's absolutely crucial if you're anywhere near retirement. The way you invest, it has to change. I mean, dramatically. The game plan that got you to the finish line, that's not the same plan that's going to keep you secure for the rest of your life. So let's break down exactly what you need to be doing. So, you've done it. You've won the race to financial independence, right? But here's the thing. Now you've got to protect that prize. It's not about how fast you can run anymore. It's about making sure that Victory Lab is comfortable, secure, and, well, lasts for the next few decades. So how do we do that? How do you set up your portfolio to make it happen? Throughout your career, it's all about one thing: accumulation. Just growing that pile of money. Every single dollar is put to work, trying to build that nest egg as big as possible. But then you retire, and suddenly everything flips. You're not growing the money anymore, you're living off of it. This is the cash that pays for, everything.
So your goal really shifts, doesn't it? It goes from all-out growth to this delicate dance between preservation and generating income. And that is a fundamental change. It means your entire investment strategy has to evolve with it. I'll say it again. What got you here simply won't get you through retirement.
Okay, so to build a portfolio that's actually, retirement-proof, we've got to get back to basics. We need to really understand the two key players in this whole game: stocks and bonds. And believe me, they have completely different jobs to do. The best way to think about it is like this. Stocks, they're your growth engine. They're the powerhouse. They've got that amazing potential for high returns, right? But that power comes with a price: high volatility. We're talking big, gut-wrenching swings up and down. Now, bonds. Bonds are your financial shield. They're the complete opposite. They're stable, they're predictable, they act like a shock absorber when the stock market gets, well, a little crazy.
Okay, this brings us to one of the biggest, most hidden dangers in retirement. It's something called sequence of returns risk. Now, I know that sounds super technical and complicated, but the idea is actually incredibly simple. It just means that a big market crash right after you retire can be absolutely devastating. Let me show you what I mean. Let's make this real. Let's walk through a little scenario, and you'll see just how dangerous this whole thing can be if you're not ready for it.
Okay, so picture this. You did it. You hit the magic number: $1 million saved for retirement. And for the sake of this example, let's say you've got it all in stocks because, hey, you were trying to maximize that growth, right? And then, bam, disaster strikes. In your very first year of retirement, the moment you stop getting a regular paycheck, the market just completely tanks. Your timing, it just couldn't possibly be worse. That beautiful $1 million nest egg you built, it's suddenly worth just $700,000. And here's the real problem. Your mortgage, your groceries, your bills, they don't care that the stock market is down. You still have to pull money out to live. And this is the killer. When you're forced to sell your stocks when they're down just to pay your bills, you are literally locking in those losses. It's permanent. And that makes it so much harder for your portfolio to ever bounce back. So, this nightmare scenario, this is exactly where bonds step in and save the day. This is their most important job. They are your defense. They're the stabilizer when everything else is pure chaos. See, by holding a good chunk of your portfolio in bonds, you've created a safety buffer. So when the stock market goes crazy and drops, you don't panic. You just pull the money you need from your stable bond investments. You leave your stocks alone, you avoid selling them at a huge loss, and you give them the precious time they need to recover. It's a game changer. Okay, so that's the theory. But what does this actually look like in practice, right? How do you go about structuring a portfolio that can do all this? Well, one of the most classic, time-tested approaches is what's called the 60-40 portfolio. It's super simple. 60% of your money is in stocks. That's your growth engine. And the other 40% is in bonds for stability. For a lot of people, this is a really solid, middle-of-the-road balance. Now, if you're someone who's okay with a little more risk, a little more bumpiness for the chance at higher growth over the long run, maybe you'd lean more towards a 70-30 split. The key thing here is there's no single magic number that's right for everyone. It's all about finding a strategy that matches your own personality. Yeah, that's the real goal here, isn't it? Finding that sweet spot, that perfect balance that lets you sleep soundly, knowing you're protected from those sudden market crashes, but also making sure your money is still growing enough over the long haul to beat inflation. So, let's bring this all home. After everything we've talked about, what's the one big idea you should take away from all this? What's the core concept you need for a truly secure retirement? It really just comes down to this simple idea. Stocks are your growth engine, they're what pushes your wealth forward, and bonds are your financial shield. They protect everything you've worked so hard to build. And in retirement, you absolutely 100% need both. Having one without the other just leaves you way too vulnerable. And really, that's the bottom line. A balanced portfolio is the key. It's what transforms that lump sum you've saved into a steady, reliable income that can last a lifetime. It's how you make sure that the financial independence you fought so hard for is something you actually get to enjoy, worry-free for many, many years to come.